With the cabinet formation now out of the way, focus shifts to the union budget expected in July. Morgan Stanley believes that policymakers will stay on the current policy path of boosting private investment. They also believe that the supply-side reforms will remain the best approach to maximizing social welfare. So to discuss this and more, we have with us Chetan Ahya, who's the Chief Asia Economist and Emerging Markets, Morgan Stanley, joining in from the sidelines of the Morgan Stanley India Investment Forum. Also joining us on the show is Lata Venkatesh. Thanks a lot, Chetan, for joining in. You know, that really is the first question. The fact that a lot of people were worried that this general election outcome would, increase worries about increasing wealth redistribution, so to say, and maybe derail the path of infra development that we saw. Do you think that should be a fear now that most of the election outcome is out of the way? We have a lot of the key portfolios continuing, ministers continuing with their portfolios. And what's the way ahead?
No, we don't think so. So look, I think first of all, if you kind of look at the election results in more granularity, some of the states where we have seen big support for the ruling coalition reflects that it's not that there's a consistent message across the nation that poor people seem that things were not great for them in the last 5 years. So first of all, the message is not very clear to read. And that's evident that, if you think about the outcome in Orissa, in Madhya Pradesh and Bihar, you can sort of question the implication from some of the market commentary that we're hearing, that the message is that it has to go more towards, the government has to go more towards redistribution. So that's the first point. The more important point is that we did this analysis on how the bottom 20% have seen improvement in their real incomes in different 5-year election cycles. And we found that in 2009 to 14, as well as between 1999 and 2004, real incomes for the bottom 20% was just about 1.3%. And of course, we saw that after that 5-year period, both of them, 1999 to 2004 and 2009 to 14, the incumbent governments suffered in the political outcome. And so the message that we read from the data is that if there is loss of macro stability, you have high inflation, and you don't have enough of investment growth and job creation, that is actually adversarial for the politicians or the policymakers who are in power at that point of time. So with that message, we think that the government should continue to stay on the path of investing, achieve moderate to high real GDP growth, and keep inflation in moderate level. And that's what will ensure that the bottom 20% per capita income or the income growth will be strong enough and bring them back to power.
Chetan, that's an extremely well-argued paper, both the inequality numbers you quote as well as the election data. But the rhetoric seems to have been gained by the regime seems to be that they need to be pro-poor. The first file the Prime Minister signed was Kisan Samman Nidhi, and the first policy decision was expanding PM Awas Yojana. So, what they ought to do is what you are arguing. But is there a very strong likelihood that they will not do that, but they will follow a more redistributive policy?
So, first of all, Lata, I think, it's not as if in the preceding 5 years there was not any redistribution spending. If you look at revenue expenditure for state plus center combined, or even if you just want to look at the central government, revenue expenditure to GDP is relatively high. The central government still runs meaningful revenue deficit. So there was spending on redistribution, and the announcement that we have heard are part of that revenue spending that was ongoing. I don't think this means that revenue deficit or revenue spending as a percent of GDP will rise. there can be some shift in allocation towards housing, as they have already announced, away from something else. But the key question that we need to answer is that, is there going to be compromise on revenue deficit and revenue expenditure in aggregate away from that allocation towards capital expenditure? As you can see, the capital expenditure as percent of GDP for the central government has been going up quite nicely, and now it's at a 20-year high. Whether that kind of reverses, my answer would be that that will not reverse. Because of the big picture that I explained, that they understand that this is actually not going to help their political outcomes, because if you don't take care of the bottom 20% by keeping inflation low, then that is going to backfire. So I think both from the economics management perspective, as well as I think the political objectives of protecting the bottom 20%, it doesn't make sense to take any measure that eventually results into higher inflation. And let's for one moment assume that they've taken the wrong message, i.e. that they're not looking at my research paper and arguments, but they're just somehow following this rhetoric which has come up in the media that they need to do more redistribution spending. The question is, why do it now? If you do it now, then you're going to have inflation in the next 2-3 years. That would not work out well for them. So even if they want to do it, ideally it would be done in the 4th or the 5th year, but in the next 2-3 years, we wouldn't really expect much.
Okay. Well, so your base case is that this year it will be a 5.1% fiscal deficit. Or are you even expecting less?
No, I think it should be around 5, and that will give them some more leeway to do more capital spending and infrastructure spending. And of course, there will be that revenue spending, which is not gone down to zero, or revenue deficit is already not down to zero. That will be maintained, and that some amount of redistribution spending will be there. But I don't see a major reversal in that fiscal consolidation trajectory or revenue deficit reduction trajectory.
Okay. Chetan, what about tougher reforms such as the land and labor reforms? Are you factoring that in at all in this in the next 4 to 5 years?
We are not. So we thought that if there was a strong mandate, they would have taken the plunge into trying out and taking up tougher reforms on. I think the labor part is more critical. The land part is still less critical. The labor part would be critical because the model for India going forward, or sustainable growth model, would be that you focus on improving productivity in farm, release that farm labor to then migrate to urban India. And for that, you just need that flexibility in the labor market for small and medium enterprises to be able to absorb this migrant workers coming in from rural India. But the laws are still a bit too stringent for the SME and the medium-sized sectors. The large corporations are fine. They are probably employing some workers on contract basis and managing the labor laws. But it's for the small and medium enterprises where they do need to implement labor reforms. But look, I think that would help to get growth to go to 8 to 10%, which would be ideal, because then that will take care of the increase in workforce that we see every year. But in our base case, we are assuming about a 6.5% real GDP growth over the medium term. And in that, we are not assuming any big reforms on land and labor.
Actually, that was the number that confused me. Why 6.5, Chetan? Look at the last 3 years, 9% in FY22, FY23 was 7.25% or 7.2, and the latest year it has been upped to 8.2%. What's your current year's forecast, and why are you not expecting at least a 7% plus growth in the medium term?
So, Lata, I think the recent years' numbers, you have to think about it that there is a significant base effect, because we went down meaningfully in 2020, and then we have been building it back. So if you look at, 4-year or a 5-year CAGR basis, or compound annual average run rate, then that growth rate is still not in line with what we should have been based on pre-COVID path. So I think there's a base effect that has been building on and helping us to grow at a strong rate. And the very last financial year, we all know that there were some adjustments on the account of indirect taxes and subsidies. But if you look at GVA, GVA growth is in the last quarter at 6.3%. So I think that, if you just take the underlying growth rates based on GVA, it looks like, something like 6.5% to 7% seems more reasonable. And therefore, we are kind of building in that kind of assumption of 6.5% growth rates.
Chetan, every expert that we speak to says that unlocking productivity of the farmland will be one of those things that will unshackle growth for us. But then again, we saw what happened the last time around this was tried. So is there any possibility of assigning a non-zero probability to an event like this?
Either, is there a possibility that they might take something up to improve farm productivity aggressively?
Yep.
Well, I think there is a possibility, but I think that, you saw that one of the things that they need to do is to allow more corporate farming and ability of farmers to sell directly to the corporate sector. And that was a reform that was being planned, but didn't get didn't get implemented. So I think there's still possibility that they may try it again. It's just a question in this political environment whether they will be able to do it. And at this point of time, we are not building it in our forecast.
What are the big sectors you will watch out for in the upcoming budget?
I think it still has to be either investment line. I think if you just look at India's investment to GDP, it has started to go up from the bottom of about 29%. It's right now around 30 to 33% of GDP. In our view, to ensure that GDP grows at 6.5–7% sustainably without having macro stability risks, you need the growth story to be driven by investment. And even when we are talking about the trickle-down effect and the job creation needs, it is always in sync with what happens to the investment line. So I don't think that the government deviates from it. There might be, of course, probably a bit of a change in their approach in terms of how they market their budget spending, and whatever revenue spending that they're doing, they might probably emphasize it more. But they can't lose the sight of the fact that you do need that investment to GDP to go up. So I would sort of build in for the next 5 years investment growth to outperform consumption growth. And within consumption segment, we are building in urban consumption growth outperforming rural consumption growth.
Okay. We are meeting you before the FOMC, so I have to ask you this. When is the first cut from the FOMC and when is the first cut from RBI?
So for FOMC, we are assuming that they will begin to cut rates from September meeting onwards. That's on September 17th. And that's premised on the fact that we expect that the next 4 inflation prints will be implying that core PCE number, or personal consumption expenditure deflator, will be around 0.2% month on month, which would be annualized run rate of 2.4. And that would give the confidence to the Fed that we are now consistently achieving numbers which are below 2.5% on a sequential basis. And that's how they begin to cut rates from September. Okay. As far as RBI is concerned, we have taken out our rate cuts about 2 to 3 months back. And our framework on that one is that you have seen this pick up in investment to GDP and productivity growth, and that the real neutral rates are higher than what was perceived to be in 2022 when RBI had published this research paper talking about a 80 to 100 basis points real interest rates. We think now real rates should be assumed to be more closer to, or neutral real rate should be assumed to be more closer to 2%. And we're expecting inflation to go down to 4.5%, policy rates stay at 6.5% with 200 basis points of real neutral rates. The other thing is that, that paper which Dr. Patra had published in 2022 did mention that if you do have a leverage cycle and asset prices are rising, real neutral rates will be higher. And maybe the next monthly bulletin where they are going to talk about this will probably emphasize on that and indicate the market that real neutral rates need to be higher. And then just one final point on that, Lata, is that, you have credit growth at 16.5% and deposit growth is at 13%. How does RBI sort of give a message to the banking system that, let me add some fuel to the fire, you accelerate credit growth, and guess what? I'm cutting policy rates, you cut deposit rate, even if you don't have your deposit growth matching credit growth. So that seems difficult for RBI to do, I think.
Okay, all right, Chetan, we're going to leave it on that note. A lot more questions, but completely run out of time. Thanks very much for joining in and speaking with us and talking about your outlook on the post-election scenario in India, as well as the FOMC and the RBI. We'll take a short break. We'll get you a lot more on the markets once we're back. Stay tuned.